He lost everything. How did this happen? He rose so fast the headlines renamed the economy after him. He launched companies. He listed them. He took pictures with presidents. He reached a paper net worth near $30 billion. Markets crowned him the country's richest man. The world believed the story. Families bought into it. Small investors bought shares. Contractors booked work. Banks lent more. The fact, multiple IPOs and a single charismatic founder. The consequence, valuations that moved faster than revenues. The human impact. Ordinary people tied their dreams to a name. He stood on a stage. He promised oil. He used one neat brand, an X on everything. He promised transformative fields and rapid production. The fact. Aggressive public forecasts for flagship oil reserves. The consequence? Markets priced those promises like cash. The human impact. Managers planned careers on future cash flows. He chose speed over patience. He listed companies quickly. He funded growth with debt. He touted reserves before wells were tested. The fact? Rapid IPOs, large bond issues, and bank loans secured on projected output. The consequence? Leverage climbed. The human impact? Employees took pay in stock. Early backers doubled down. Early drilling produced press releases. Stock charts ticked up. Net worth climbed in public feeds and magazine covers. The fact? Initial announcements of discoveries and fast-rising paper value. The consequence? More capital arrived. More lenders said yes. The human impact. The founder bought jets, yachts, homes. Staff took photos. The nation cheered. Risk. Technical uncertainty. Decision. To treat optimistic reserve estimates as certainty. Consequence. Balance sheets extended against potential, not proven, cash flows. Human impact. Retail investors saw account statements soar. Then the first delays arrived. The fact? Rigs reported slower drilling. Test wells underdelivered. The consequence? Technical caveats crept into press notes. The human impact. Rig crews worked overtime with paychecks that might vanish. Analysts asked for data. Board minutes showed bullish language. The fact? Public statements optimistic. Private notes cautious. The consequence? A gap formed between market-facing claims and internal reports. The human impact. Mid-level managers worried about projection lines and spreadsheets. A new risk surfaced. Debt covenants. Decision. Roll short-term debt into larger facilities. Consequence. Maturities clustered. Human impact. CFOs aged faster. Then the moment that changed everything. The fact. A flagship oil company reported negligible production instead of the promised commercial flow. The consequence. Trading froze. Lenders pulled credit lines. The human impact. Private jets were seized. Luxury became collateral. The company's balance sheet had no quick fix. A cascade began. Margin calls hit. Bond prices plunged. Banks marked loans to market. The fact? Covenant breaches and forced sales of collateral. The consequence? Asset seizures and repossessions. The human impact? Pilots escorted jets away. Yacht crews unloaded. Executives scrambled for cash. New risk. Market confidence as collateral evaporated. Decision. Sell minority assets to raise cash. Consequence. Selling at fire sale prices. Human impact. Long-term projects were canceled. Workers were laid off by the hundreds. A forensic economist draws a chart. The fact. The company's value depended on future production discounted into today's prices. The consequence. When production forecasts fell to near zero, the discount collapsed. The human impact. A paper fortune of roughly $30 billion collapsed towards zero in about 18 months, roughly a 97% wipeout. Every new quarter introduced new shocks. Fact. Downgrade after downgrade. Consequence. Institutional buyers wrote down positions. Human impact. Pension funds and mutual funds showed losses in client reports. Governance problems appeared in the documents. Fact. Related party deals and optimistic reserve notes. Consequence. Auditors and regulators opened files. Human impact. Confidence drained from managers who had tied careers to the empire. A key decision repeated itself. Double down on public storytelling instead of transparent reporting. The fact, glossy investor events and repeated promises of fast production. The consequence, narrative sustained temporary rallies, then collapsed again under technical setbacks. The human impact, retail investors who bought on the story lost savings. At midpoint, read the documents for yourself. Visit the documentary site to see drilling logs, board minutes, and reserve reports. New risk, contagion to banks. Decision, banks that lent large sums started provisioning losses. Consequence, credit tightened for other commodity explorers. Human impact, capital markets charged higher terms for smaller players. Debt holders sued. Regulators opened cases. The fact, the holding companies filed for the largest bankruptcy seen in the region. The consequence, asset auctions, receivers, auditor scrub. The human impact, thousands of jobs were cut. Suppliers lost revenue. Family savings were damaged. A series of short scenes. A laid-off rig worker holding an unpaid final paycheck. A retail investor checking an account balance down 80%. An exhausted executive staring at ledgers while custodians move jets off the tarmac. Each scene follows a fact, then a consequence, then the human cost. Legal teams combed emails. Forensic auditors compared promised volumes to actual test wells. The fact, discrepancies between reserve forecasts and geological outcomes. The consequence, prosecutors and civil plaintiffs sought answers. The human impact, a founder who once spoke as a national hero now faced courtrooms and media volleys. Another risk, reputational asset as collateral. Decision, use celebrity status to attract new lenders. Consequence, reputation could not substitute for proven barrels. Human impact, large institutional investors were embarrassed in shareholder meetings. The collapse timeline speeds up. Fact, 3 downgrades in 2 months. Consequence, trading suspended on key tickers. Human impact, employees lost access to stock-based compensation worth millions. Forensic explanation, plain and sharp. Assets on the balance sheet were priced on future cash flows. Those cash flows required production. Production was not there. Leverage multiplied losses. One missed quarter became a chain of margin calls. One error in reserve estimation turned into billions in write-downs. One credibility hit triggered legal entanglements. The math is simple. The outcome is brutal. New risk, liquidity spirals. Decision, sell non-core assets to cover runs. Consequence, buyers paid pennies on the dollar. Human impact, community contracts ended. Local economies felt the shock. Market ripple scenes, banks write down loans. Hedge funds pull lines. Smaller commodity firms see borrowing costs spike. The fact, systemic tightening in the sector. The consequence, investment slows for years. The human impact, young engineers find fewer jobs. By the end, the founders' listed net worth neared zero. The fact, the fortune fell roughly 97% in around 18 months. The consequence, the holding companies filed for bankruptcy. Assets were seized and auctioned. The human impact, a nation's brief icon falls to a cautionary tale. Interviews show regret and anger. A laid-off welder speaks of lost years. A small investor shows a 401k statement that reads like a cautionary note. A former executive speaks quietly about choices that felt right then. Each human voice shows loss, layered on top of loss. The final forensic read, 3 forces combined. 1, a market that priced promises as if they were proven assets. 2, governance lapses that let optimistic reserves masquerade as collateral. 3, heavy leverage that amplified small misses into catastrophic losses. But the single clearest structural failure was this. The system accepted future production as present value without enough independent verification. That failure let narrative replace proof. It let credit be extended on hope. A short, plain lesson. Capital markets reward stories. They must also demand proof. Numbers must be tied to tested wells, audited reserves, and conservative debt structures. The human cost of failing to do that is real and long-lasting. Final call to action. See the evidence yourself. Visit the documentary site to read the documents, drilling logs, and board minutes. We close on a simple image: a jet towed away, a silent rig in fog, an empty office with a single framed headline on the floor. The voice returns. The fortune disappeared. The question is answered. The cost remains. Learn the checks. Demand the proof.